So Tesla investors are used to FUD going around, but Tesla is not the only company which is misunderstood. Bradford has actually been saying for years now that NVIDIA is misunderstood. There was about a year ago that NVIDIA was just starting to take off, and people were looking at the PE ratio of like 100 and looking at all these kind of historical looking metrics and just saying, whoa, it's like overvalued and this rise is overdone. But with benefit of hindsight, now we can say no. Bradford was actually right and got ahead of this name to the benefit of our investors. So there are opportunities for investors out there who are willing to go a little bit deeper in their analysis than just kind of looking at the historical metrics, applying a PE ratio, and saying, "Hey, look, this company looks a little rich for this market." So what we're trying to do with all of the companies that we're looking at here, and today we're going to be looking at a company called Bloom Energy, which definitely falls into this category, is going a lot layer deeper. So you will see that we're going to go deep into the financials. So we're not saying financial analysis isn't important, but we're also going to look deep into the technology, into the use cases, and into what we think the opportunities are. So this is going to be a little bit of a longer video, but we think it's really important to fully understand the story of Bloom Energy and really put the energy piece of it together with the finance piece of it and talk about all these different inflection points that are coming and why we think Bloom Energy is actually significantly misunderstood and poised for a bit of a rally here. This is not financial advice. We are financial advisors. We are invested in Bloom, but you should do your own research and come to your own conclusions. We're just going to lay out our case here. So Elon has warned about an electricity shortage. Anyone who's been watching NVIDIA and knows that there's this chip shortage because all these new data centers are being built, and NVIDIA, even though they're increasing their supply, can't increase their supply fast enough to meet the demand. Well, all these GPUs, which are out in the field now, are going to also be increasing demand for electricity. So this is a big part of the trend that Elon was talking about. And when you look at some of the other dynamics in the grid, with renewables especially being added to the grid and interconnect queues really increasing in time, and then a lot of the base load coal power being retired, you are seeing increases in volatility in grid prices, and you're also seeing companies that are trying to connect facing increasing difficulties. So we're going to listen to a brief clip from Barry Sternlicht, who is the chairman and CEO of Starwood Capital Group. Starwood is the fourth largest owner and operator of data centers in the United States. And here's what he has to say about what's the key bottleneck to their data centers. And spoiler alert, it isn't access to chips.
So power is the most key ingredient. Can you get the power? And of course, in many places in Europe, they have no excess power because we have power because we have gas and we have the ability to create power. And we have other less environmentally friendly sources of energy, but the gas that we have, which is virtually endless, will create the electricity that we need to drive the data centers that will drive the AI revolution through the companies that populate the stock market.
So Barry's comments were maybe a bit surprising for some of you. In this day and age that we're in, you might think that all the new electricity load is going to be met with wind and solar and then to some extent batteries. And we certainly are believers in those technologies. We think they're going to continue to gain market share, and it's good for the economy. It's good for society. But there are some significant drawbacks which you can't overlook as an investor, and that is the most significant of which is that they're not firm. In energy speak, firm power is power that's there when you need it. So when you flip on the light switch when you're home, you don't want to have to think about, oh, do I actually have enough access to electricity in order to afford to flip on this light switch? And data centers, which are much larger users of electricity, have a similar problem. Utilities are aware of this problem, but if any of you have worked with utilities, you will know that they are notoriously slow and conservative when it comes to this sort of thing. And so even though they're seeing significant increases in demand, which is certainly a good thing for their bottom line, they're not necessarily moving fast enough to meet this demand. That's why when Elon was talking to Patty Poppe and her executive team a couple months ago, Patty Poppe is the CEO of Pacific Gas and Electric, PG&E, which is the very large utility operating out of California. He was basically just saying, hey, whatever you think you need in your forward projections for electricity, you're too low. You need to actually add way more electricity than you're projecting. um, we're starting to see this become a real problem. U.S. grid interconnection in 2023, the backlog of interconnect projects trying to go through the interconnect process jumped 40% in 1 year. I mean, that is a massive change. Wait times are expected to grow as more projects go through this process. I won't go into the whole deep dive of the utility interconnect process, but the very high level overview is that this is a legacy process from when you used to add a couple projects here and there, like large coal plants or natural gas plants every once in a while. It was like relatively easy to study the impacts they would have on the grid, and you could turn an answer around from doing these studies in 2 years or so. With the advent of a whole bunch of new solar and wind very small projects going through this same process, which has not been redesigned to account for the changes in trends, what we're seeing is just that the studies are becoming way more complex and it's taking longer to go through all the different iterations. And then you have projects backing out of the queue, and so then you've got to go back and restudy. And so that whole process is taking an extreme amount of time. And frankly, there's a huge amount of uncertainty as projects can just get stuck with a 7 or 8 figure bill, which to pay for grid upgrades that they weren't planning on. So the amount of uncertainty in that process has really increased quite substantially. The typical project, which was approved through the interconnection process in 2022, actually entered the interconnect queue 5 years earlier in 2017. So imagine if you're a data center operator right now and you're trying to compete in the AI arms race and get your models, up and running and get your data center pumping to with the latest NVIDIA GPUs. You want to get the best AI solution out there. You cannot afford to wait 5 years to go through this interconnect process. So this is a trend in a new dynamic which we really haven't seen before. Dominion Energy, who is a large utility operating out of Virginia. Virginia, for those of you who don't know, is actually one of the largest hubs of data centers in the country. There's a massive amount of data centers there, and a lot of new projects we're looking to get added into that region. Dominion Energy just flat out said that they can't meet the demand, and so you're going to have to wait 5 years to connect to the grid there. So we're seeing this where this really significant change in dynamic where if you're just trying to operate a data center, typically you got to look at your engineering, your construction. You can get your chips, and you need to build your project. Like this isn't a super complicated infrastructure project in terms of lead time for a lot of these items. But when you're met with a 5 year lead time to connect to the grid, or your local utility basically just saying, sorry, like we literally won't serve you for 5 years, that is not an acceptable answer. So utilities are not going to be the savior for the AI arms race. So a lot of data center operators are going to start having to take matters into their own hands, we believe. So next, we're going to go to a clip from Bloom Energy's Investor Day last year. The speaker here is Dean Nelson, who has been building data centers for 20 years at companies like Sun Microsystems, eBay, PayPal, and Uber. And he now leads a nonprofit trade org called Infrastructure Masons. So he's going to share a little bit about his views on what's happening in the industry, the kind of mindset for the engineers that are making these types of decisions right now, and how that's changing. And I think he's got a really interesting perspective. It's a 7-minute clip, so sit tight and kind of get through it. But I do think it's important to show it in its entirety because this is such an important change, and it's one of these inflection points that we were talking about at the beginning of the video. So here's Dean Nelson, and we'll catch you on the other side.
So you have some of the biggest companies in the world, and I'm literally talking about all the hyperscalers, 85 co-location companies, everybody in that market trying to figure out how do we solve it. Because if they can't economically, development-wise, they go to other places. But guess what? The other places are running out too. California, Arizona, Utah, they're all having these constraints. So the ability to now say, I can do a microgrid, bridge that gap, right? Increase resiliency is the only answer. So 10 years later, we've come full circle into saying, can we now use this technology to hit all the different things that we're trying to accomplish? But the number one is, if I don't have power, I can't serve the world.
What do you think the forcing functions are where, while you were an early pioneer and early adopter, not all data centers, we've had some success, but not all data centers have adopted as their standard architecture. What do you think forcing functions are now where you see that changing?
Yeah, there's actually a couple factors here. First one is, if I don't have access to capacity, I have to come up with another answer. That's a pretty
Necessity
simple one.
being the mother of invention.
There it is, there it is. And I really believe in forcing functions because that's when innovation happens. When you work under constraint, you come up with creative solutions. So we've seen this time and time again in history. So where we are in the industry right now is America, Europe areas, and then Asia, right? The growth patterns are incredible. Mm-hmm. And so that's one factor. There's just not enough energy in the right place. The second one is that we have a climate crisis, as KR outlined earlier. I think the world has woken up. And to me, this comes down to the investors, because follow the money, that's where things happen, period. If you don't have the money behind it, you're not going to be able to move something.
These guys.
Yes. So from my perspective, now you've got the biggest investors in the world saying, I am going to go focus on sustainable investments. So the money is moving that direction. Secondly, you have the biggest companies in the world focusing on climate goals. They're publicly stating net zero by a certain time frame. They don't know how to get there yet, but they're making that commitment. So between the investment dollars and those commitments from the largest companies in the world, that's the forcing function I think that's going to cause this to happen. Because that innovation that will come out of it, and I'll give you an example. Microsoft put out a fund that said, we're going to put $1 billion out there for anybody who can come up with innovative solutions to help us meet our sustainability goals. We're going to open up our patents. You can use them. That drives, acceleration of what we're trying to actually get done. That's what gives me a lot of hope. One other thing I want to mention is that I'm the chairman and founder of Infrastructure Masons. This is a professional association that is uniting the builders of the digital age. Think of all the people that build that engine and operate that around the world. The AWS is Google, Meta, Microsoft, Digital Realty, all those companies. We came together last year because things were not moving fast enough from a climate standpoint. So we gathered at a person's house, 40 executives, and said, let's find one thing that we can do together to address climate change for our industry. Just one. That was one of the most difficult things to do. Simplicity is. But we got it down to it, and the iMasons Climate Accord was born. That accelerated really quickly. Within 6 weeks, we had 73 companies signed up for it, including AWS, Google, Meta, Microsoft. Another 6 weeks after that launch, we were over 200 companies. 200 companies who represent over $6 trillion of market cap, all united on one goal. That is where I see real movement. So you take the investment side, you take the capacity constraints, and you take the public commitments, and everybody's aligned in to say, we're going to go achieve that goal because we have no choice not to. We must do it.
Well, it might be obvious to some. How do you see this as an opportunity for Bloom, and how does Bloom fit into this?
It's a pretty simple proposition if you think about it. And let me tell you, I'm not paid for this. I'm here because I actually have been a longtime believer in Bloom.
We did buy you dinner.
That's true. Yeah, okay. I think the key is that there's a real, I'm trying to figure out how to put this. Our industry is extremely risk averse. They're very conservative. So they don't want to go back and try new things. When we go back and say, hey, remove your generators and UPS, put in a fuel cell, it'll be fine. Every engineer in the room goes, oh my God, I can't do that. Now when you say, I'm out of power, we have to come up with a solution. Every engineer goes and puts on their hat and figures it out, and guess what? I can do on-site generation. The actual natural gas lines are more resilient than the electrical lines. Like, they start doing the math because they have to solve a problem. So I think from Bloom's standpoint, the fact that we've got all these constraints in existing markets that are mature, that's one opportunity. Secondly, when you think of the emerging markets who do not have energy resilience but also have capacity problems, that opens up the door across the board. Whether it's Africa, India, anywhere across Europe, there's opportunities. So I think it is unbound when it comes to it.
Well, thank you. We've been long time committed to data centers. We know we have a great solution there, and it's leaders like you that are helping lead the way in the industry. Is there anything else that you'd like to add in closing?
Um, I would say that number one thing is we should be challenging the status quo. There's a lot of people that think conservatively of how we're going to approach these things. We don't have time, we don't have time to actually wait. From the climate standpoint and the growth globally, that is really critical. Generative AI, I know you keep hearing these buzzwords. It is predicted now that infrastructure globally will triple in our industry. Remember that 2.4%? Imagine if that goes to 8 or 10%. We have supply chain constraints right now. We have capacity problems all over the place. We must come up with ways in which we're going to serve this demand. I don't see any other answer except microgrids within our industry to solve and bridge that gap to get both sustainability, cost, and capacity solved.
All right. So as Dean pointed out, fuel cells haven't taken off because they haven't really needed to take off historically. The process has become increasingly difficult for data center providers in recent years, but they've still been able to actually build out the infrastructure that they've needed. But that is really starting to become a serious pain point, as we heard from Dean and as we heard earlier from Barry Sternlicht. So the fact that energy is becoming like the number one topic on these data center owner and operators' mind tells you how serious this problem is. So we're going to pivot here to talk about the financials of Bloom in just a second. But before we do that, I want to just take a higher level zoom out and say that this problem that is facing the energy sector is not just about data centers. Data centers might be feeling it most acutely because there's such a significant growth in that sector right now. And they're the ones really feeling the pinch of the energy shortage. But if you're anyone trying to connect to the grid, if you're a new grocery store, or if you're a new medium-sized business, a new like industrial customer, you are still dealing with these same pain points. Struggles with working with utility are impacting you as well. Fuel cells have historically not been a cost-effective methodology or solution to address that challenge. But now fuel cells, as you'll see when we get into this in a little bit, are actually at price parity in many use cases, not all, but in many use cases, with utility provided power. And then on top of that, they can meet this time to power challenge and this regulatory challenge. So we're gonna pivot here going into the financials, but before we do, one last point that I don't think I touched on yet on the data center front or on the fuel cell front is that we hear Barry talking about natural gas being extremely important, and it's one of the reasons that America is going to be able to kind of compete in the AI arms race, because we do have access to cheap, plentiful power. So Bloom fuel cells do run on natural gas. That's why they can be so effective at kind of meeting this short-term need to get firm fixed power today. And they actually generate the power without combusting the natural gas. So through a chemical process that actually is able to split the methane in the natural gas into electricity as an output, and then it emits almost pure CO2. So it is releasing greenhouse gases, which is certainly a knock on the company's green credentials. But the thing that I think is extremely impressive about them is because they don't combust the fuel, there are no NOx or SOx particulates. You don't even with one of the most fuel efficient utility scale, what's called combined cycle natural gas power plants, you still have a significant amount of particulate matter and other kind of nasties that get emitted to the air because you're combusting the methane. With Bloom, you're actually getting the fuel efficiency of one of these massive, super efficient combined cycle natural gas plants that actually uses heat recapture and a steam turbine, and these things are like massive and extremely complicated and capital intensive. You get the efficiency of one of those with, for the most part, lower pollutants, and you can actually site them on site. So you're obviously not going to site one of these massive power plants on your data center, because that's just an industrial use case. It's a whole different permitting situation. But with these Bloom Energy servers, they call them, they're actually so modular and quiet and aesthetically pleasing, and they take up a relatively small amount of space given the power that they output, that you can actually co-locate them on site with where you're using them. This is an extremely important advantage because when you're doing that, you're actually able to offset the delivery costs of power. So most people may not know this, but when you're paying for electricity as a data center or as a even a retail customer, 2/3 roughly of your delivered cost of power is actually the transmission and distribution costs. So the cost of the wires to actually take the power from that power plant to you as the end user. So Bloom is actually able to get the efficiency of that centralized power plant while avoiding the entire cost of the wires that will bring you there. So this is one of the reasons they can be so cost effective is because you can deliver on site extremely efficiently.
Are you a Teslanaire eager to further grow your Tesla shares? At Rebellionaire.com, Bradford Ferguson and Matt Smith have demonstrated their aptitude, consistently delivering groundbreaking, world-first research featured on platforms like Tesla Daily, Dave Lee on Investing, Solving the Money Problem, Limiting Factor, and Farzad Misbahi. At Rebellionaire.com, we go beyond just holding shares. We strategically trim and add, capitalizing on the stock market's emotional fluctuations. Our approach involves selecting additional exponential growers like NVIDIA, which we believe are undervalued by Wall Street. We use covered calls to create cash flow from stocks, even those without dividends. Our financial planners craft a personalized master plan using a first principles approach, addressing all aspects of your finances, not just your investments. Our goal is to consistently increase your share count, avoiding missed opportunities during market FOMO or panic selling, and minimizing tax liabilities. If you're ready to enhance your share growth with our help, visit Rebellionaire.com.
So with that kind of setup and keeping in mind that this is a problem facing everyone in the energy sector, not just data centers, so that makes the TAM of this opportunity like that much larger. Let's take a look at the company's financials. All right. So what we are looking at here is the company's most recent quarterly financials for the quarter ended September 30th, 2023. Bloom is actually going to be reporting very soon, a couple days after this video has been being recorded. But let's take a quick look at their financials. So we have total quarterly revenue of 400 million, and the cost of revenue is 405 million. So, that immediately off the bat just looks horrible. You have a negative gross margin. You add in some operating expenses, interest expense, and then all of a sudden you're at like a net loss of 169 million dollars. 80 cents per share. Terrible. So a lot of the historical numbers that people have been looking at, and actually I'll show you some other numbers here real quick. So a lot of the criticism of the company from the financial community historically has been around these sorts of, frankly, understandably disappointing numbers. So here we're looking at a kind of longer time frame of the company's revenues. So one thing you'll notice off the bat is the revenue growth rate has been phenomenal. So we have the latest period. This is the trailing 12 months up here. In 2017, for that whole year, they did 366 million in revenue. In the trailing 12 months, they've done 1.4 billion. So top line growth has been nice, but when you look at EBITDA, it's still disappointing, and maybe most importantly, when you look at net income, it's actually trended the wrong way. So you actually had a higher loss on a base of 1.4 billion of revenue than you did when you were just selling just 366 million. So a lot of the financial analysts out there, and myself included, by the way, I was actually short Bloom 2 years ago or so, but we were essentially looking at these numbers and saying, okay, like you've got no prospects for profitability. You've been losing money for the better part of 2 decades. Bloom's only been public since 2017, so we don't have the numbers going back historically. But like Bloom has always been out there. They've been the future of energy forever, and it's always been like a bit of a joke because their numbers are just a mess and their technology's been too expensive. So the point is that it's very understandable that the company has been dismissed by the financial analysts out there for a number of years, but then also by the energy analysts out there because their energy offering is uncompetitive on price, and then the finances show that the business hasn't really been a moneymaker. But let's try to go a layer deeper and see why I think there's actually some really exciting opportunity. So going back into the company's latest earnings presentation, I want to share the adjustments. So anytime you get into adjustments, like adjusted EBITDA or adjusted earnings per share, anything like that, like my eyes are definitely going to roll, because it's like, all right, if you're one of these companies that has a $10 million loss, and then like you got stock based comp and all these other things that you're adding back and saying, look, we're actually profitable, but it's a litany of items to add back, uh, which is the case here. I certainly understand that kind of skepticism, but if you're looking at this, there should be a number that really jumps off the page, and that is this impairment charge. So you have $130 million impairment charge. I won't go into the full details of what this is, but the very high level summary is that they were selling electricity as opposed to hardware for some of their uh, clients or projects in the past, and they're actually taking a massive one-time hit right down on that part of the business, backing off some interest expense that's going to be associated with that. But it is a one-time item that like is the actual reason why you would have these sorts of adjustment tables that are actually legitimate in my mind. So when you look at these numbers and you say, okay, you're going from like a pretty significant gap loss, and here let's go down to the net loss. So a net loss of 169 million, but adding back this impairment charge and then this interest expense, which I'll get to in a second as well, they're actually showing an adjusted net profit of 15 cents per share on a diluted basis, which is huge. And we'll get into the reasons for this in just a second here. But it's if this is a real number, this is extremely impressive. Um, the reason that I think it is a real number, and I'll stop sharing for just a second here, is that the company has actually been extremely effective at cutting the costs out of their production process. So this has been one of the more legitimate knocks on the company historically, is that their cost of goods sold is too high. One of the things I think analysts are not really paying attention to is just how significant their cost of goods sold reductions have been over the years. So we're going to switch over to the model that I pulled together to kind of walk through some of the changes that have happened historically and run through some different sensitivities. All right, so now we're taking a look at the model that I have. We'll be staying in here for a little bit, so let's get you oriented first. So we've got historical quarters in gray here. We have the product cost, which is just the average selling price. So the product revenues divided by the number of kilowatts of product that you're selling, and then the cost of goods sold. So obviously the kind of difference between these two numbers is going to be your gross margin. The thing that I think I'm not hearing any of the analysts out there talk about, and which is kind of blowing my mind, is just how significant of a job Bloom has done in reducing their cost of goods sold. So we actually toured Halter Ferguson Financial, myself and one other person from the firm, toured Bloom Energy in Q3 of 2023. We're able to see this new facility where they are making these fuel cells now, and it was extremely impressive to hear the team there talk about all the different improvements that they have already implemented to date. But maybe what got me more excited is the continued improvements that they have planned for the short term and the medium term. This is a 2 gigawatt plant, and just to kind of level set you, this year Bloom's going to be doing around 300 megawatts of total sales. So there's room to almost 10x production capacity out of this site, and the level of improved efficiency that they would get out of there is really staggering. But to just take a look at the historical picture, so in Q1 they were actually able to reduce their cost of goods sold from 23.94 to 21.92. In the quarter before that, they were at 25.30. So they are taking hundreds of dollars of costs out, like per quarter. And if we were to look back a little bit on what these figures looked like in prior years, they were over $3,000 just back in 2020. So the amount of cost cutting that they've done and the focus that they've had on manufacturing manufacturing efficiency is really starting to bear fruit right now. And this is something that I don't think the analysts are paying attention to. I don't know how many of the other analysts are actually touring the plant, but when we were there, the cost savings seemed really real. And when we saw the Q3 report drop, it was an extreme validation of our thesis based on the things that we had seen in person in the plant. But let's take a look at the rest of the equation. So like we said in Q3, the company had a profit if you were to back out the big increase in this PPA impairment charge that we saw run through. And then also there is a huge amount of interest expense on some convertible debt that was issued by Bloom and held by the company's number one customer, which is a company called SK Ecoplant. So we'll be talking about them a little bit more later. But the big thing that happened in Q3 is that this convertible debt, SK Ecoplant opted to actually convert this debt into equity. So the interest that had been accruing on that debt is going to get wiped away. So we're going to see this kind of normalize down to a more typical $15 million or so interest expense level going forward. And then obviously we're not going to have the impairment expense really dragging down the gross margin on the electricity side of the cost of revenue equation. So looking forward, it's extremely important to kind of make these sorts of adjustments. So let's go back up to the top and kind of look at things at a high level. So the company gave guidance over here of revenue for the full year. This is the current year-to-date numbers of $977 million in revenue. So they're saying the full year is going to come in between 1.4 and 1.5 billion dollars. So that gives us some kind of clues as to how many megawatts we could be looking to sell. And they also said on the latest call that they are not seeing any need to decrease their pricing. So they said that they're seeing a lot of interest and they're recognizing the value that they're providing to customers. So they said that they're trying to hold firm on pricing. But what that would say is that you should expect the roughly 3752, or let's just call it 3700 or so in ASP that they've been able to realize in Q1 and Q3, that should stay reasonably flat. SK Ecoplant, we do believe, has lower pricing than the average customer, so maybe that comes down. But essentially, in order to make the numbers work, we have to significantly drop the ASP. Let me show you what I mean. So if we assume that management didn't really mean what they said, and they actually dropped the ASP to $3,200 per kilowatt, and let's assume that there's not any significant cost of goods sold improvements this quarter, then they would essentially have to sell 100 megawatts in order to make these guidance numbers make sense. So full year full year revenue would be roughly $1.4 billion, which is on the low side of their guidance here. But certainly makes sense. And the gross margin would actually be higher than they've guided for. So they guided for adjusted gross margin of around 25%. With the numbers as we plug them in here, we're getting full year gross margin of around 25.6%. And the reason is, if you look at these numbers, that when you have a $3,200 per kilowatt average sale price and a $2,144 cost of goods sold, that's a 33% gross margin. So their gross margin seems set to kind of explode. And if you essentially look at what it was historically, so in this latest quarter, they had a 42% gross margin because they're selling the product at $3,752 and their cost of goods sold is only $2,192. So something about management's guidance is striking us as extremely conservative, and this is going to be more important when we look to 2024. But let's just assume that their conservative guidance is reasonably right, and we're still a little bit high on the non-GAAP gross margin, but it's at least within the ballpark. Well, scrolling down, I'll just cut to the chase because this is already a relatively long video. But scrolling down, we're going to get adjusted earnings per share in this quarter of 9 cents. So this would be a very impactful number. We would actually see a GAAP loss of just 3 cents, so getting really close to GAAP profitability. But again, these numbers don't really strike me as reasonable. For one thing, I think this $3,200 figure is just way too much of a decrease given what management has said. And for another, they've been able to take out roughly $150 to $200 of cost per quarter for the last several quarters. And based on what we saw at the plant there, I think that cost decrease might continue to maybe not accelerate, but I think there's more runway left to pull out costs out of their product, especially when they're doing higher volumes like they will be doing in Q4. So let's maybe look at a sensitivity around here. So let's just assume a more modest ASP decrease to 3,500. And let's assume, so if we assume a 33% margin here, we're going to get a nonsensical answer where the cost of goods sold is going to actually increase sequentially, which just doesn't make sense based on what we've seen. So let's instead just assume that we get a 5% sequential improvement in cost of goods sold. Maybe that's even too high. Let's just make it a 2% or 3%. So a 3% improvement, which means we're going to get $70 per kilowatt of costs pulled out. Well, then all of a sudden we have a 39% gross margin. So this kind of blows up the full year guidance numbers because we'd have a non-GAAP gross margin of 27.3%. But honestly, this looks a lot more reasonable to me than the numbers that you have to kind of contort yourself into in order to meet management's guidance. So this seems a little bit more reasonable, and when we use that figure, we're actually getting a GAAP positive earnings per share of 9 cents and adjusted earnings per share of 22 cents, which is like that would be an absolutely mind blowing figure for the company to post in Q4. So then this becomes an extremely pivotal quarter because if management was really sandbagging and we have mid to high 30s gross margin potential, and our product is starting to see some more adoption, then we could be seeing significant revenue growth at significant margins when the company has really achieved some cost discipline as well. I won't go into the operating expense side because this video is long enough, but there has been a lot of cost cutting that they've done to kind of right size the business over the last couple of years. But let's just take another crack at kind of looking forward. So let's undo those couple changes we just made and go with this base case, which again strikes me as a little bit on the conservative side, but let's just start there. Management has provided guidance of medium term, like 5-year to 10-year guidance of revenue growth in the 25 to 30% range, which I think Wall Street is just like flat out discounting. They're saying, no, that's not possible. But let's just assume that that's a little bit high, but they can still do 20% volume growth. But revenue growth would actually be lower than that because ASPs are declining. So that's what we have here. We're assuming 20% increase in megawatts deployed every quarter. And then we're having the same, actually here, let's keep our margins flat at 33%. And let's assume that our ASPs continue to tick down to get to this, 3,074 figure by the end of the year. So in this scenario, we're getting full year. Actually, I've got it at the top here. We're getting full year adjusted earnings per share in 2024 of 13 cents. And if you just apply a 50 PE to that, that'd be $6.26 share price. The stock right now is in the $11 range, so this would be a decrease. But if you look forward and you just assume these assumptions maintain, then you're looking at 2025 adjusted earnings per share of 36 cents, and that gets you to a share price of $18.22. So this is where I think a lot of the upside is starting to show that if you can keep the top line growing while maintaining decent margins, the potential is there. But again, these numbers don't really make sense to me. I don't know why the price would decrease so much. And if the price were actually to decrease to these levels, let's think about that in economic terms. That would mean that their product, which is already cost competitive with, and in many cases better than utility rates in several jurisdictions, would be all the more cost effective. And so if that were to be the case, you would expect volumes to actually increase pretty substantially relative to this 20% figure that we've assumed here. So let's just do one more quick analysis here. Let's assume the top end of their range said, and let's just do 30% volume growth with the ASP decreases that we've seen. So when we do that, we get 2025 adjusted earnings per share of 58 cents at a 50 PE. That'd be a $29 stock price. So to me, that would make a little bit more sense with the declining ASPs. You might even argue that the 50 PE is too low. So if it's at 100, then that would be a $58 stock price. But the point is, I think a lot of the analysts covering, I don't think are looking at the stock in this level of detail. Let's do one more sensitivity where we're, instead of assuming the ASP just gets chopped to kind of maintain some seemingly reasonable margin assumption, let's just assume that our ASP sees like a 2% sequential improvement each quarter. So let's start that here, and we'll go this times 0.98, kind of run that through. Oops. We'll run that through here. It doesn't really matter. And then let's assume that our ASPs also decreased by 2% a quarter. So we're seeing decreases on both sides of the equation here with this assumption. So if we run that through into 2026, all of a sudden we're getting, 2024, so current year adjusted earnings per share of 84 cents, and 2025 adjusted earnings per share of $1.23. So this is either one of these scenarios would be an absolute home run compared to what the market is expecting. If you look at analyst projections for 2024, they're roughly split. Half of them think that Bloom is not going to be profitable this year. The other half think they will. The top end of the range that I've seen is in the roughly 30 cents for the full fiscal year 2024 range. So if Bloom were to roughly double that, the stock price reaction would be quite drastic in our estimation. So this is where we think some of the opportunity is. We think it's really misunderstood as a company, and maybe to drill that point home a little deeper, I want to share some pieces from a Bank of America report on Bloom. So let's just compare what we just did in that model with what Bank of America is projecting on their model. So in their most recent model, which they're assuming a share price, or they have a share price target of $10. So really a modest decrease from where we are right now. They're assuming that revenue will decline in 2024 and will essentially only tick up 3% in 2025. And then for some reason, it will increase 27% in 2026. So to me, this just seems like kind of nonsensical. And then the other thing that kind of cracks me up is they're assuming, this 25, 26% gross margin, because that's roughly where it's been historically. And why stick your neck out and assume like a 30% gross margin or a 35% gross margin when that seems like a rather aggressive call. But it's just not first principles thinking. They're just saying, looks a little risky. They've got some customer concentration. What if volumes don't grow? I know management guided 25 to 30% revenue growth, but what if it's flat for 2 years and then their margins don't improve? So my point in kind of hammering all this home is I don't think you can have your cake. You can't have it both ways. You can't have that the margins are going to be 25% or so, and say that the technology is going to be price uncompetitive, because the only way, if you assume their cost of goods sold is going to stay flat or continue to improve, the only way you can get to 25% gross margins is if you drastically cut the price. And if you do that, you're going to make the product so much more attractive that you're going to have crazy volume growth. The only other way you can do it is to, essentially assume that you're going to maybe even raise your prices or something like that, and not have volumes show up. So your gross margins aren't going to be that strong. So I think this is just a nonsensical projection here. I don't understand a scenario where these numbers could come to pass. So the other thing which makes me think that they don't really know what they're talking about is they talk about Bloom's technology here, and they say, we view their technology and relative economic proposition to be more supportive of backup power applications than primary electricity generation. I'm sorry, but if you have that note in your research report, you don't know what you are talking about. Let me explain. So Bloom's technology is extremely high in terms of capital cost. So it's roughly $3,700 per kilowatt we saw on the ASP. That is like 7 times higher than like a diesel backup generator, something like that. It's even higher than like the capital cost of a combined cycle natural gas power plant. So you're not going to pay that significant of a premium on your upfront cost for something that you're never going to use, that you're only going to use for a few hours a year in backup capabilities. The only reason Bloom's product makes sense at all economically is because it is so ridiculously efficient. It has a heat rate of around 7,000, which I won't go into the details of what that means, but it is like extremely impressive. It's extremely efficient at converting fuel into electricity. Like we said earlier, it's about as efficient as those like massive centralized combined cycle natural gas plants. So to be covering the company and to think that it has more economic use case and backup power is just a nonsensical thing to be saying. So this whole thing, when I'm taking a step back and what does this look like? It kind of reminds me of Tesla in 2019 or so, maybe mid 2019, before they'd really proven they were profitable. To me, like the pathway of Model 3 ramping and the cost advantages that they were going to have in Fremont seemed pretty evident. It seemed clear that there was a path to continue to reduce costs um, and, and continue to grow volumes as well. That's exactly where Bloom is. They've got a factory that can roughly 10x in output capability. They've got a proven track record of continuing to reduce costs. They have brand new extension of a deal with SK EcoPlant, their largest customer, to be doing very large projects. There's a project in South Korea, which kind of went unnoticed, that SK EcoPlant is building a data center there that's going to be going live this year. That's 100 megawatts. Keep in mind, Bloom's going to be doing roughly 300 megawatts this entire year, and this one project is 100 megawatts. So, like all these things are starting to add up. You're hearing the data center companies talking about how this is becoming a problem. Use, I just don't understand how use could not increase. Now, maybe it's a little bit lumpy. Maybe there is for data centers in particular. These can be longer lead time sales projects. So maybe for the Amazons and the Microsofts of the world to really get on board and start ordering these in bulk, it might take some more proof of concept. And Amazon does have a project in Oregon that we're tracking really closely, which is going through an air permit review right now. So we're watching that closely. We think that's going to be a really strong kind of leading indicator of whether more projects opt for or more data centers opt for Bloom's solution. But the technology seems to be on a very clear path. And we just think that the kind of talking heads, if you look at the comps that were in that report, by the way, it's like they're putting in Bloom in with like solar companies and with other like clean energy technology companies that are really frankly not comparable companies. Enphase is one of them. Array Technologies is one of them. These companies are not at all comparable in terms of the types of products and solutions that they're offering. So it's just kind of like comical to me that you're using like your MBA investment banking kind of methodology to be analyzing this company that is really standing on its own. Nobody else really has a product like Bloom. So I think applying comps to it just doesn't really make a lot of sense. So at a high level, I don't think that these people that are covering the stock are really extrapolating the trends and are listening to the data center earnings calls and presentations that these companies are doing. I don't think that they're actually touring the plant the way that we did. And I don't think that they're willing to stick their neck out right before an earnings call and say, hey, I think the gross margins are going to surprise to the upside. I think the company's solution is going to see a lot more widespread adoption. I think it's much easier and much more safe to assume that margins will revert to the mean instead of doing the first principles analysis that we're doing here. So at a high level, that's kind of the investment thesis. A couple other thoughts before we wind down. We have said that Bloom's costs will continue to trend down, but let's take a really high level view of what that means. So if their costs continue to trend down, then they will either have really strong margins, or what we think is more reasonable is that their ASP will continue to decrease. So if they continue to decrease their ASP, then their relative competitiveness to the utility business model is going to look like more and more and more and more attractive to customers. This is kind of a crazy flywheel. We know what the utilities are going to do with their rates. They're going to steadily increase them year over year. You can read their filings. It's extremely transparent. That's what they're going to do, especially on the transmission and distribution side. There is no world in which you're going to see utility rates decreasing like 2% a year on average. So utility rates are going to continue to increase while Bloom's costs are coming down and Bloom's price will come down. That is going to really widen the TAM, and that makes the prospect of selling gigawatts per year a lot more reasonable. And if you look at this company and you look at the model where you're going from 300 megawatts of sales to 5 gigawatts of sales potential in some hypothetical future, I mean, this company has massive runway well beyond the 2 years that we modeled in this video. So that's something that I think is extremely overlooked as a long-term catalyst, where this could not only be a good trade for the next couple of years, but this could be a massive trade and investment for a decade or so. Now that'll take some time to pan out, obviously, but it certainly is a possibility. Another thing is innovation. So we talked a lot about data centers in this video. Just this week, Bloom launched a new product which actually couples supercapacitors and inverters with their solid oxide fuel cells to allow for really dynamic, instantaneous load following. So what that means is if you have a spike or a drop in usage really abruptly, which it does happen at data centers from time to time, that can be very hard on machinery, and that can be hard on transformers and electrical equipment. And Bloom's by using supercapacitors, actually able to kind of absorb that very quickly, and able to really tailor their product to meet the use case of that particular customer. They also showed, and actually here, let me share my screen. They also showed that they can use the same technology to provide cost savings in retail environments. So this is a white paper that Bloom put out just this week, like I said, where they show the kind of data center use case here. I'll go through it very quickly. So you essentially have this kind of strong base load power, but then if you have this sharp sudden drop, which can happen in a matter of just seconds, your supercapacitor can handle that, and you'll essentially be charging your supercapacitor during that time, or discharging your supercapacitor, I should say. So that's kind of an interesting use case, and one where they're listening to their customers and finding ways to add more value. When they are looking at the cost of this, they're here it is. They run some numbers here and say, okay, a 10 megawatt AI data center, the average cost of this over a 15-year life of the project is going to be $227 million. They're saying that Bloom can actually undercut the cost of this. So you'd be saving $60 million, a little more than that, by using Bloom. Now, 50 million of that is what they call opportunity cost. So this is the time to power advantage that they talked about. So not needing to get through the interconnect queue or work with the utility. The fact that you can actually get the Bloom data center up and running extremely fast, that's a real advantage. But even if you strip that out, they are roughly at cost parity, a little bit better according to their numbers. And I looked at these numbers; they're actually very reasonable in my mind. They're using a cost of energy of 12.5 cents, escalating 3.5% annually. And on the Bloom side, they're assuming natural gas costs $9.50 delivered, which is strikes me as a little on the high side, to be honest with you. So the point is, I don't think they're gaming these numbers to show this cost advantage. And then on the retail side, so this is a new use case. Imagine like a grocery store or something like that, where rather than kind of sizing your Bloom server to the maximum load that you'd be doing, like you would in a data center use case, you size it to the minimum load. And so because it's so efficient, you're able to have lower cost of power for this kind of base load. But then by using these supercapacitors, you're able to provide some grid services and get more cash flow that way. So when they do this kind of cost comparison here, you're seeing a utility cost of $1,000, $1 million, I should say. You're getting really significant baseload savings, but then you're also getting these ancillary services payments that are kind of additive to what you're able to do. So Bloom's being extremely innovative in some of the stuff that they're doing on the technology side. One other thing I want to point out, which could be really huge, is on carbon capture. So Bloom's servers, like we said, they don't emit NOx and SOx and particulate matter. Coming out of the exhaust is actually like a 95% pure CO2 stream. They are working right now to find ways to do direct air capture or some other method of taking advantage of that carbon, and you could then get a carbon credit, which would increase the economic value of the project. The U.S. does have credits for that, and on top of that, you have actual 100% firm, clean, zero carbon emitting power, which for the Amazons, Microsofts, Googles of the world is an extremely attractive thing. That's what they're trying to move towards. There's just not a solution that kind of ticks all the boxes right now of being clean and of being firm and of being available now. So Bloom being able to actually crack that CO2 problem would be a massive win. It could be something that I would see spurring a lot of new volume wins in the future. So one other item, which we haven't even touched on, is what I would call a massive call option on hydrogen. So the same Bloom solid oxide fuel cell technology that uses natural gas as an input and kind of outputs electricity, you can use the same technology but input high temperature steam or just water and electricity, and you can essentially electrolyze that water to get pure hydrogen out and then emit oxygen to the atmosphere. So in that scenario, you actually have an extremely fuel efficient or electricity efficient methodology for electrolyzing hydrogen. It's actually 30% more efficient at converting electricity into hydrogen than the kind of standard electrolyzers that are out there right now that are like PEM or alkaline technology. So they've got a huge upside optionality there. We think that market's going to take a lot longer to develop, and frankly, there's more risk on that side of the business. Hydrogen seems like it's always been the technology of the future for a while. We do think there are real use cases, particularly in like hard to abate sectors that were talked about in the Tesla master plan. There's also use cases like creating ammonia for fertilizer and things like that. That would be really good to decarbonize. And Bloom's technology works extremely well when coupled with industrial processes like nuclear or combined heat and power plants, where you have a source of steam, which is just a waste product. If you can use that waste product as the input into a Bloom fuel cell or a Bloom electrolyzer, I should say, you get extremely efficient and cost competitive hydrogen. And a lot of governments around the world, from the US with $3 per kilogram credit, South Korea, Germany are really incentivizing this. And Bloom's actually deployed some of these already, which might be surprising to some. But there was a pilot project in UC San Diego, I want to say, one of the California campuses, has both a Bloom electrolyzer and a Bloom fuel cell in the same project, essentially just showing how you can use the technology to create clean electricity and hydrogen. There's another project in South Korea which is going to be being built. So the technology actually works. It's proven today. We also saw their hydrogen electrolyzer when we were visiting out in California last year. So the technology is real and it works. It's just in our minds the market isn't quite there yet. Lastly, let's talk about risks. We've been very bullish on this, obviously, but there is no shortage of risks associated with this. I think the biggest one is that SK Ecoplant, who we've mentioned a couple times in this video, is by far their largest customer. So the customer concentration is well north of 50% for SK Ecoplant. So if they no longer see value or their volumes don't materialize, that's a very significant risk for the company. When we're thinking about this risk, we look at the fact that they actually converted their debt into equity, and they also recently announced an increase in their order volumes with Bloom. That was in December. So in my mind, if you are SK Ecoplant and you're thinking that your volumes aren't going to increase, or you think you might all of a sudden leave Bloom holding the bag with a large plant that is over capacity relative to your expected orders, you would not have converted that debt. You just keep the debt because it's a safer return guarantee, but instead they opted to convert that into equity. So now they benefit directly from their orders continuing to increase, and from other customers seeing the benefit as well. So in our mind, SK Ecoplant, it just doesn't make sense that their orders would dry up, but that certainly is a risk that for a variety of reasons, their largest customer could stop making orders. The other risk is that other volumes don't materialize. So let's say this Oregon data center gets a bad air permit, it just isn't approved for whatever reason, and other data centers don't opt for the technology. Other people are just conservative and don't opt for it. We could be in a scenario where Bloom never really significantly increases volumes from this level, and so then maybe we are kind of at this roughly break-even volume level for a while. So in that case, then Bloom's probably about fairly priced in my mind. And the other risk is that cost savings don't materialize. So we talked about our expectation that cost of goods sold will continue to trend down for Bloom, but especially in a scenario where the volumes don't materialize or that they actually go the other way, it's certainly possible that the cost of goods sold could kind of trend the wrong way. So there are other risks as well. This is not financial advice. We are financial advisors, but this is really the type of in-depth research that we really pride ourselves on doing here at Rebellionaire. We're going to take our own kind of first principles approach. We're going to do the research and roll our sleeves up. We're going to tour the plant. We're going to follow the trends that point to expanding gross margins and expanding use cases and therefore higher volumes, and make models and investment assumptions based on that. But it can be risky. But if you're interested in learning more, check us out at rebellionaire.com. We're obviously big Tesla bulls and enthusiasts as well. So we're not financial advisors that are going to tell you need to sell down your Tesla to get to some concentration that makes me feel more comfortable at night. Your risk is your risk at the end of the day, and our job is to help you along the journey. So if you want access to kind of more details on the other names that we're doing this type of research on, check us out, and we'd be happy to hear from you. Thanks for watching, and we'll see you next time.